how should you be looking at the market overall, the ingredients and portfolio approach? Aniruddha Sarkar of Quest is here to talk more about that. Aniruddha, afternoon. Thank you so much for your time. Let's start by understanding your framework for 2022. Broadly, for equities, how are you really going about tackling your strategies?
Yeah, afternoon, Ajay. I think, after an excellent run in the last 18 months, wherein practically, everyone has made very good returns, I would say that, investors need to be now a bit more alert with regard to constructing their portfolio and not get actually too over excited about the construction. One thing investors should also understand that, basically the returns, what we saw in the last 18 months is something which will not get repeated very often. And with that, what we are telling investors is that, they need to get their expectations from the markets aligned to what should be there in line with what the earnings will be there. I think the period of easy money making is behind us. And, when practically in the last 18 months, it didn't matter what you bought. Rather, what was important is to be participating in the market. Moving ahead, I think in the next 4 to 6 quarters, selection of companies, sectoral exposures will make a very big difference to the portfolio returns, because I think, earnings, they need to justify the valuations and the price movements. We actually see the strongest set of earnings, coming from the banking and financials, both the lending side and NBFCs, IT and IT services, and cyclicals is something which we have been focusing on for the last almost 11 months. And we believe within the cyclicals, something like the home improvement, the real estate, cement and building materials is something which will do exceptionally well over the next 12 to 18 months. If I look at the broader earnings expectations, I think on the earnings front, we are expecting the broader index to report earnings anywhere between 16 to 17% over FY23. Whereas, I think if one looks at a portfolio construction and is able to pick up the right sectors, which I just mentioned about, and within them construct a portfolio, building a portfolio of earnings growth anywhere between 24 to 25% is not very difficult, which is actually the earnings growth of our portfolio. Thus, our focus, and I would say investors' focus, should be to build a portfolio where the earnings is going to grow faster than the market.
Let's talk about your portfolios. I see large portions, devoted to larger private sector banks. Some of them are talking technology a whole lot. A recent analyst meet done by ICICI Bank, there's a view that that 1.5 to 2 year kind of a shadow which the banking sector had gotten itself into is likely to get over, and from here on, corporate banks will start doing very well. What's your thinking on it?
Absolutely. That has been our outlook also on the banking and financial, because, if you look at our portfolio construct over the last 18 months, for most part of this 18 months, we have been heavily underweight on the banks and the financials, and for obvious reasons, because of the pandemic, the type of impact it had had on its earnings. That, I think, has really worked well for our investors, wherein the underweight stance on banking and financial was really very helpful. If I look at a portfolio over the last couple of months, we have been increasing our exposure to the financials, because I think most of these banks, I would say the ones which are kind of with a strong balance sheet, they have actually come out of the woods, and valuation is something which is very comfortable. Corporate lending is something which is an overweight stance in our portfolio anyways, with the big private sector and public sector banks in our portfolio. Apart from that, we have some good quality NBFCs also, which definitely, I would say, the recent correction also gave a very good entry points. So I would say banks and financials is something which we, from an underweight stance, have got into an overweight stance in the last couple of months. And I think investors should also align, because both earnings and valuation is very comfortable in that area.
Aniruddha, talk to us about your thinking behind home improvement. I see a lot of home improvement stocks also in your various strategies. Does it look like a structural, durable theme to you?
Absolutely, Ajay. So I would say that, the whole home improvement and the real estate space is something we had started building overweight position almost like 14 months back. Our thought process was that after almost a period of 6 to 7 years, you're finding the real estate market coming out of that bad patch, wherein, you had inventory levels sitting at all-time highs. prices at extreme top ends wherein it was not affordable. And at the same time, your interest rates were not very conducive. What has changed is all of these have turned around wherein the home loan rates are at all-time lows. Demand has picked up thanks to pandemic and the understanding from consumers that you need to have your own house and also an extra home. At the same time, the prices have corrected, I would say, decent enough in the last so many years that now the whole idea of taking a mortgage and going for an outright purchase makes more sense. And all this has led to a massive decrease in the inventory levels across the different metros and also in the smaller towns. Now, the home improvement is something which is an ancillary to the real estate, and that is something we have been focusing on, whether we're talking about the plywood companies, MDF companies, the tiles, sanitary ware, paints. I think all of these companies are something wherein earnings have been excellent in the last couple of months. And I think we have not yet touched the peak with regard to the margins and with regard to the earnings growth. There's a decent, I would say, 12, 18 to 24 months type of a space wherein these companies can continue to grow. And if I look at the managements of these companies and interactions with them, practically all of them are looking at expanding their capacity, and definitely they know something much more than what we know. And that gives me confidence that this whole home improvement and the real estate space is something which definitely will do very well for investors over the next couple of months.
Right. Aniruddha, what are your thoughts on the mid-cap, small-cap end? Do you see that one has to be wary about it, or you see adequate correction happen in case for value or cherry picking over there?
See, I would say with regard to mid caps and small caps, basically the way I look at companies is I don't try to segregate between the large, mid, and small, because we might find expensive valuations even in the large cap space, and we might find attractive valuations even in the mid and small cap space. The whole idea, what we try to do is that we try to look at individual sectors, and within those sectors, who are the ones which gives me that comfort for both value and the earnings growth. Having said that, as we speak, I think the last couple of months correction which we have seen in the market, there are several mid-cap companies and small-cap companies which I would say have come at very good valuation levels, because if I look at most of their earnings growth, at least if I talk about my portfolio companies, whether we talk about the auto and auto ancillary, we talk about the specialty chemicals, we talk about some of the IT companies. I think many of these companies, the valuations have become very, very I would say attractive, and earnings at the same time are poised to grow anywhere between 18 to 24%. So definitely, I think valuation for many of these companies have become very attractive, but one needs to be very careful. I'm saying again and again, it's not a time where when we just go and buy outright any mid and small cap. We have to be very selective in the sectors, and within the sectors, picking up the companies who have strong visibility of earnings over the next couple of, I would say, at least 12 to 18 months. And that is where we are trying to position our portfolio in.
Okay, one last question. Out of all the sectors and themes which you have across all your strategies, which, if you can give some idea, where do you see the strongest earnings growth in the next 12 to 24 months?
I would say it's my old favorite, which has been kind of my core in the last 15 months, which is the whole IT and IT services. Now, when I talk about IT and IT services, many people contradict saying that, the valuations are expensive, which I think when you will agree that, valuations are not very cheap in the whole IT and IT services space. But I think what we need to see is that IT companies is one space wherein you have a huge number of opportunities. Whether you talk about the large cap IT companies, mid cap IT companies, or the small cap IT companies, there's a huge basket you can pick and choose. The other good comfort which we get is that this sector is one sector which is giving me a great visibility on earnings over the next 18 to 24 months, and not just the next 1 year, but over the next 18 to 24 months, it's giving me a decent earnings growth visibility. Now, what has changed is that, obviously we are all aware that, because of COVID, the demand for whole migration to the cloud enabling technologies, all this has led to a massive opportunity for Indian IT companies. Along with that, the whole work around cloud migration, cloud-based data, and also the new areas of spending like, cybersecurity, ESG, all this has opened up huge gateways for Indian IT companies. And in fact, if you look at the numbers of Indian IT exports, it has gone beyond $190 billion, which is much more than our oil import the figure of around 175 billion. So that gives me a decent enough confidence that, IT is a space wherein you will find comfort and earnings growth, and should be definitely a core allocation in everyone's portfolio. And this definitely is going to be one space I will remain bullish over the next 12, 18 months for sure.
Very much for that. Let's take a short break on that note.